So Dave Ramsey says, don't buy whole life insurance for cash value. And I'd say he's about half right, because he's also talking about buying it from companies like Gerber, a whole life insurance company that also sells baby formula, and I probably wouldn't buy it from them either. See, I like the old giant companies, the ones that pay 5 to 6% dividends over 20, 30 years, and even paid those dividends during the Great Depression. This shows real financial strength. But not all companies do this. You see, not all companies and policies are created equal in this space. But the good ones are going to let you have a very flexible, low death benefit right to the IRS limits, load up on paid up addition riders, and borrow with no direct recognition loans. Those are key features you want to look for. Without those features, Ramsey's right. It's probably just a waste of money and a waste of time. A few other realities though that you need to know are age, your health, and how much you're funding the policy all play a huge role. These really matter. The worse your health, the more it's going to cost to insure you, and that really takes away from the cash value, which kind of defeats the whole purpose. Now, can the market outperform a cash value policy? Well, yeah, but it can also lose money as well. Will my policy lose money in a down market? No. Is the stock market money taxable when you go to sell it? Yes. So what happens if you pull out a few $100,000 and the market tanks and now it's down 20%? That's no good. But with a properly designed life insurance policy, you're not going to lose anything, and your money is just going to keep compounding uninterrupted. So there's pros and cons to everything. This isn't a one-fix-all type of solution. And when you borrow money against your policy, you're actually using the insurance company's money, not yours, meaning that your cash keeps growing untouched. Even better, the small interest that you pay back is the tax deduction, and tax-free when used properly. Meanwhile, your money keeps working. You're now worth 10 times more dead than alive to your family and their future. And you can even borrow large chunks of cash if you become severely ill or disabled. The stock market doesn't let you do that. Not saying that that's a bad thing, but this is why we diversify. This is why investors, families, business owners, farmers, and anyone with a large estate uses this as a strong financial tool, not a one-size-fits-all type of thing. And at the end of the day, it's not about comparing the stock market to insurance. That would be ridiculous. But it's about protecting your empire and leaving a legacy and doing it correctly. So yes, I agree with Dave Ramsey, but don't at the same time. I just think that there's a lot more to the story. So if this helped, please like, subscribe, comment, or book a call with me through one of my links wherever you're watching this. And let's protect what matters. See you on the next one.